are far from done yet. That's the promise to the American people. We are far from done. We're committed to bringing inflation down, and we'll continue to work until that job is fully done.
I don't think the Fed has the thread right now. We have, by every reasonable measure of core inflation, inflation running somewhere plus or minus 5%. That is not acceptable by any dimension.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Here's what's coming up on today's programme. A bumper jobs report adds to the case for more tightening from the Fed. That's as investors count down to Wednesday's CPI print. Maintaining the pressure, China extends military exercises near Taiwan. Plus, an arm and a leg. Softbank reports a more than $23 billion loss and plans an up to $3 billion buyback. Let's check in then on these markets. You had that massive loss from Softbank. You have the news around the exports and that export machine, that engine out of China really ramping up. Another record, the highest number since we've seen since about the mid-1980s, towards the end of the 1980s. And then, of course, we're contending with that very tight labour market. And Jay Powell's been very clear about that. The tightness of the labour market, he thinks, will be able to support the economy as they push through these higher rate hikes. Now, of course, we're looking to September, and increasingly the view is you're going to get 75 basis points, 3.5% unemployment, more than 500,000 jobs added. That data came through, of course, on Friday. Gains of 0.5% across the benchmark here. In terms of how things are breaking down, you have the auto sector propelling the DAX higher by 0.6%. Here in the UK, gains of 0.4%. Basic resources part of the mix as well. Energy and that sector gaining on the back of higher Brent. Iron ore is up as well. We have some breaking lines talking of the auto sector from Porsche over in Germany, of course. First half profit after tax coming in at 3.24 billion euros. That is up 32% year on year. Porsche saying that net liquidity was about 500 million euros, and they still see full year profit after tax of between 4.1 billion euros to 6.1 billion euros. So they still see full year net liquidity between 200 million and 700 million euros. So those are the Porsche lines crossing. We'll get some more details on that when it comes through, see how it plays out across the pricing as well. We do have bumper US jobs data. We had that out, of course, on Friday, adding those 528,000 jobs for the month of July. And it tempered really recession fears. It also means the Fed will likely continue with its aggressive pace of tightening. We heard from a number of guests on Bloomberg TV.
This is the payroll pushback.
There is a path to be had to soft landing here that the Fed so badly wants to engineer.
We're not at neutral. The Fed is going to have to do more, and hopefully it won't break the economy.
It's really clear that they are on a path to continue to raise those rates.
They're not going to be able to pivot as aggressively as the market was expecting.
Fears about hot inflation on the one hand, and we've got fears of imminent recession on the other hand. So this market is sort of trapped here.
The market thinks the Fed is going to make yet another policy mistake.
OK, we are joined now in the studio by Anna Titareva, European economist at UBS. Anna, good morning. Thank you for joining us.
Morning.
Does the jobs data change your view on the trajectory for rate hikes from the Fed?
Well, here I will have to refer to our U.S. colleagues' view. They still currently stick to a call for 50 basis point hike, but they did flag that, of course, very strong jobs data does imply some upside risks.
And I know, well, let's shift from the Fed then to your zone of comfort, which is, of course, the European economy. And I know you've been modelling out inflation. We're looking ahead, of course, to the US inflation print on Wednesday, and the expectation that's going to moderate somewhat. We heard from Larry Summers saying, look, the core inflation is still very high. What is the inflation situation in Europe? What is the modelling telling us about whether we're at peak inflation and to trajectory, to what extent that starts to come down, at what pace, at what time frame?
Well, the modeling for Europe has been very, very difficult recently. And of course, gas prices and another spike in gas prices play a big role. So at the moment, our forecast assumes that Eurozone inflation is going to peak in September at 9.3%. but we do flag upside risks, again, referring to gas prices. First of all, there is uncertainty in Germany specifically, where government is planning to introduce a levy on gas prices, essentially trying to pass on more of the wholesale gas price increase onto consumers. We've incorporated that into our forecast, but there is still uncertainty about the details. And of course, based on our modeling of various recessionary scenarios, we said that if we come to a scenario where Europe has to ration gas, then the spike in gas prices is likely to be even more, and therefore that is going to pass on into even higher inflation.
So with all those important caveats around uncertainty and, of course, what happens in terms of gas flows out of Russia, that view of 9%, with all those caveats in September, what does that mean for ECB?
Well, for the ECB, we said that after, compared to our expectations, an upside surprise in terms of the July decision, we said that given the inflation dynamics, we expect them to deliver another 50 basis point hike in September and then switch to a lower pace of 25 for October and December. But we did flag that if we come down the path of rationing or deeper recession, then ECB potentially would have to stop earlier.
Is there a scenario at this point where the Eurozone can avoid recession, or is it just too baked in at this point?
Well, at the moment, our base case is that we're currently still sort of plugging in high energy prices, but we don't get disruptions on the volume side. At the moment, we said that growth is likely to stagnate in the second half of the year, but we did flag that once this higher gas prices come through in Germany, and if we get any announcements on the rationing side, then it would very unlikely be that we could avoid the recession.
Yeah, it really is still all about gas, isn't it? And I know you've been mapping out as well the kind of corporate response, how the major companies across Europe are adjusting to this environment in terms of hiring and spending, particularly around CapEx. Just unpack some of the key findings from that and what it tells us about the corporate health across Europe.
Yes, so we do our own survey of Eurozone corporates across Germany, France, Italy, Spain. Our previous survey was done in February before the start of the war, so we do have to take into account sort of a higher starting point. But what our latest survey from June and July shows is that if we look at sort of key metrics of CapEx intentions, employment plans, pricing power, and profit margins, across all those four metrics, companies' expectations have come down quite significantly. And it's not just sort of at the headline level, it's a broad-based weakening across sectors and countries. It's a broad-based weakening. I remember coming into this and a number of strategists lining up and focused on that CapEx response as a support for a bullish equity view at the beginning of this year. But you're saying that CapEx response has moderated significantly across these corporates. Where is that being felt most acutely? Where are they pulling back on CapEx and moderating their spending plans? Well, we do sort of a more higher level breakdown, so we wouldn't be able to say specifically which sectors. But what seems to be driving is this moderation is uncertainty about the outlook, uncertainty about, once again, gas situation and what it means in terms of, for some sectors, specifically for their production as well. Okay, Tatiana, very pleased to say, Anna, very pleased to say that you're staying with us. We'll get more from you, your views across the Eurozone economy after the break. That is Anna Titareva, of course, European economist at UBS. Coming up, we will focus on Europe's energy crisis, which is being made worse by the decline of what is happening, of course, in terms of gas and what's happening in the Rhine, the river, as well. That is up next. This is Bloomberg. Economics, finance, politics. Welcome back. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Now, water levels in the Rhine River have been dipping perilously close
to the point at which the waterway would have to effectively close. That could risk the trade of huge quantities of goods as the continent seeks to stave off an economic crisis driven by higher energy prices. And in spite of the higher price tag, Siemens Energy posted a bigger than expected loss in the 3 months through June, weighed down by problems at its Spanish wind turbine subsidiary and restructuring of its Russia business. Earlier, we spoke to Christian Bruch, who is the CEO of Siemens Energy, about their performance.
We see that all the products across the board are needed for the energy transition, and also they have been resilient in this very difficult market environment.
OK, that was the CEO of Siemens Energy on the back of those results. Anna Titareva, European economist at UBS, is still with us. And Anna, we're looking then at the ecological deterioration across Europe as a result of the climate crisis and then the renewable energy sector. And that brings me to a question about the fiscal response from governments across the Eurozone as they weigh up these pressures on the energy system and that need to rapidly transform the economy to a more renewable-driven energy base. To what extent will that fiscal stimulus offset some of the other drags on this economy?
Well, our view has, since the start of the year, has been that it will help to mitigate some of the sort of downside impact, but it won't be able to fully offset it. Compared to the start of the year, we've penciled in additional 2.5 percentage points of GDP in fiscal stimulus in Europe. And in general, we changed our view from slight tightening to net easing in terms of fiscal impulse. But again, the key view is that it's still not going to be fully sufficient to offset the negative impact.
When we switch focus to the UK and that very bearish outlook from the Bank of England and Governor Andrew Bailey, as we look ahead all the way through to 2024, this long, prolonged recession that is being drawn out and outlined, at least by the central bank of the UK, does that align with your view? How fragile is the UK economy? Are they being overly bearish at this point?
Well, our view has been that when we look at this year's performance, UK would outperform the Eurozone, but it was largely driven by strong start of the year, strong Q1 GDP numbers. But our view has consistently been that when we look at 2023, given the mechanism of how utility tariffs are being set in the UK and the fact that the April increase didn't capture the price spike following the start of the war in Ukraine, and that is going to hit UK consumers only in October, we said that UK economy is likely to be slower compared to the Eurozone in 2023.
But do you think it extends out to 2024, that almost two-year time horizon that the Bank of England have laid out?
Well, we think at the moment our end of our forecast horizon is 2023, but in general we think that it will depend largely on the energy price outlook because now we know that Ofgem has changed the mechanism of how utility tariffs are being reviewed. But in any case, if we see gas prices moving higher from here, then it's going to remain a drag for some time to come.
Liz Truss, clearly still leading in the polls when it comes to these Tory members. She could well end up being the Prime Minister of the UK, and she says that she wants to change the mandate of the Bank of England. Is the Bank of England's independence at risk at this point?
At this point, we don't think so. We'll need to see what exactly she means by this statement. We've seen some comments from Governor Bailey at the press conference last week saying that when it comes to inflation targeting, it's already the Bank of England's single mandate is inflation targeting. So we'll need to see what she exactly means.
Well, she's threatening to scrap that inflation target. And if that was to go through, if she was in fact able to work that out, and do that, what would that mean for the Bank of England, how it operates, if that inflation target was removed from its mandate?
Well, we'll need to see what she wants to introduce instead of that. Right. So at the moment, it's too early to say. Too
early to say. We continue to watch that story, of course, as Liz Truss continues, it seems, to lead in the polls, at least, amongst Tory members. Thank you very much indeed, Anna Titareva, European economist at UBS, on the UK, the health of the UK economy, and, of course, the broader Eurozone as it faces up to these continued energy pressures. Coming up, the US Senate passes a huge tax and climate bill. We're going to analyse the impact it could have next. This is Bloomberg. Happy Monday. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. A couple of individual corporate stories to tell you about, some movers to focus in on. And you do have Veolia. This is a company that's managed to sell, under pressure, regulatory pressure, to sell its Suez UK waste unit to Macquarie. That is a $2.4 billion deal after coming under scrutiny from UK regulators over its decision to buy that broader French company. Siemens Energy cutting its profit outlook for the full year, currently down 2.6% on the back of that news, taking a hit from its Russia business. And Jules gaining, almost 43% on the back of speculation and reports that Next, the retailer, is going to be taking a minority stake in that UK-listed business, up 42.4%. Right, let's get the Bloomberg First Word News now with Leanne Gerrans. Leanne.
Good morning, Tom. China's trade surplus hit a record in July, with dollar exports growing 18% year-on-year, beating estimates. Its trade balance climbed to about $100 billion, beating the previous record set in June. Imports climbed by 2.3%, slightly below the median forecast. The numbers ease some fears about China's growth challenges as it sticks to its tough COVID-0 approach. Now, Hong Kong is reducing quarantine for inbound travellers. That's starting on Friday. Arrivals will spend 3 days in hotel quarantine, down from 7 days. After that, they will be subjected to 4 days of health monitoring at home or in a hotel, with some restrictions on movement. Hong Kong has reported over 4,000 COVID cases a day since the middle of July. Ukrainian officials say Russian forces shelled the area around Europe's largest nuclear plant for a second day. The attacks happened hours after the head of the UN's Atomic Safety Agency warned of what it described as potentially catastrophic consequences. Moscow has denied targeting the plant. Kremlin forces occupied the facility and surrounding areas back in March. The UK economy probably shrunk for the first time since the coronavirus lockdowns at the start of 2021. Economists surveyed by Bloomberg predicted GDP shrunk by 0.2% in the second quarter. The Bank of England last week forecast that inflation will accelerate past a 40-year high to more than 13% this year. It sees a downturn to last into early 2024. GDP figures are due out this Friday. And an Italian centrist party has ended its alliance with the ruling Democrats. The Azioni party had agreed to join forces with the Democrats to prevent a right-wing landslide in September elections following the fall of Prime Minister Mario Draghi's government. Polls signal that with other political forces divided, the right-wing coalition may be headed for a decisive win. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Tom.
Leanne, thank you very much indeed. Now, the US Senate has passed a landmark tax, climate and healthcare bill, speeding a slimmed-down version of President Biden's domestic agenda towards his desk, if they get it, of course, through the House on Friday. Let's get more then with Bloomberg's Bruce Einhorn. Bruce, what are the details? What really stood out to you in terms of the contents of this bill?
Well, Tom, it's much smaller than what the Democrats had been talking about a year ago. Back then, the talk was several $1 trillion worth of spending. This bill is $437 billion. It also doesn't include a lot of the things that a year ago were central to President Biden's Build Back Better plan, spending on education, spending on health care, spending on child care. That said, only a few weeks ago, most people in Washington thought that this bill was dead. There was going to be nothing. So instead, there's now going to be $437 billion. That includes $374 billion in climate spending, tax credits for renewable energy, subsidies for people buying electric cars. There's also going to be a minimum corporate tax, 15% for some of the largest companies. There's going to be additional spending on healthcare, helping people with their Affordable Care Act premiums. There's going to be, for the first time, Medicare will be allowed to negotiate with pharmaceutical companies for some drug prices. That's something Democrats have been trying to pass for a long time. So all in all, there's a lot there that the Democrats are hoping that they'll be able to take to voters in the fall as they approach a midterm election that's still looking a little dicey for them, given that Republicans up until now have had a whole lot in their favor. More recently, the Democrats have started to have some wins, so it is leading to hope among some that there's going to be a closer election.
Okay, well, that's obviously to watch for in November. I have to say, I was glued to the live blog yesterday, amendment after amendment from Republicans and Democrats. The legislative process is complicated, to say the least. How does it unfold between now and Friday? What is the process for getting this onto Biden's desk?
Yeah, it's a good point. What you watched was what they call the vote-a-rama, where they have amendment after amendment voted on. It's just part of the procedure. What comes next is rather straightforward in comparison. So the Senate has passed the bill. Now it goes to the House. Nancy Pelosi, Speaker of the House, has said that there will be a vote at the end of the week. The Democrats have a majority, a slim one, but it is a majority. It seems likely that this bill will pass the House, at which point it goes to the president for his signature. So all things seem to point to that this is actually going to become law.
Okay, Bruce Einhorn, excellent job. Thank you for walking us through the implications of that bill and the time frame as well to getting it onto the president's desk, if it does get there, of course. Out of Hong Kong, thank you. Coming up, as investors warm up to technology stocks again, we're going to focus on Softbank's earnings, which came out earlier today. They were pretty brutal. Stay with us. This is Bloomberg. Welcome back. Here are your top stories. A bumper jobs report adds to the case for more tightening from the Fed. That's investors' countdown to Wednesday's CPI print. Maintaining the pressure, China extends military exercises near Taiwan. Plus, an arm and a leg. Softbank reports a more than $23 billion loss and plans an up to $3 billion buyback. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Let's get back to that Softbank story and unpack it for you then. Markdowns at the Vision Fund and a $17.2 billion shortfall led to, well, what was a record net loss and a second consecutive quarter of losses for Softbank. The company monetized some of its holdings in Alibaba and T-Mobile, while IPO in waiting Arm posted good growth figures. A weak yen also caused a $6 billion net loss due to Softbank's dollar-denominated liability. So the FX impact there, part of the mix. Let's bring in Bloomberg's Charlie Wells for the details. Charlie, record losses. We talked about the FX component. What else was at play here?
Yeah, so this really is a casualty of the tech slowdown in that second quarter. We saw the NASDAQ 100 down 22%, and that really did affect Softbank. But interestingly, in a very dramatic press conference just a few minutes ago, we saw founder Masayoshi Son blame himself. He said that he was embarrassed. He took responsibility for the overconfidence that he had in making some of these investments in a very bumper 2021. Most notably, he presented a picture of a 16th century Japanese shogun, Tokugawa Ieyasu, who lost a very important battle only to later go on and help unify Japan. And I think that's a theme we're likely to see him try to draw on going forward.
I'm glad you've detailed the contents of that picture, because we were looking at it, certainly the team in the gallery were, trying to work out what it all meant. So thank you. So a bit of hubris then from Masayoshi Son. What do we learn, what do we glean about what's happening within the private markets when it comes to valuations? Are they starting to come back? This is a little backward looking, of course, these earnings.
Yeah, Tom, that's what everyone really wanted to know. What about these sort of hot potential unicorns in waiting? What is their value? And, over the past few months, Klarna, we saw that valuation drop from about $40 billion to about $10 billion. We saw ByteDance down about 25%. And what we heard in this press conference was that of the portfolio companies in the Vision Fund, about 60% had seen those valuations drop.
60% saw the valuations drop. What happens to Masayoshi Son? He's showing that he's taking responsibility for the hit. And as he looks ahead to an environment where tech, at least in the last 30 days or so, has seen something of a rally, but yields remain, of course, volatile. What is happening across the tech space and how it plays into his future?
The strategy here seemed to be owning it and maybe trying to find a bottom that one could potentially recover from. Of course, that is the shogunate theme that he was trying to draw on very prominently. But he also talked a lot about having more investor discipline, trying to find greater cost efficiencies, but still keeping that vision that he has for the Vision Fund going forward.
Okay, on the chauvinistic themes there through Softbank. Thank you very much indeed. And of course, that important briefing by Masayoshi-san after a record loss for Softbank. Charlie Wells, of course, of Bloomberg, breaking it all down for us. Let's stay then with the tech theme. We are joined now by Hermann Hauser, a co-founder and venture partner at Amadeus Capital Partners. Hermann founded Acorn Computers in 1987, which was later spun off to create ARM, of course, which is part of that whole debate as SoftBank looks to a listing at some point. Hermann, thank you for joining us from Cambridge. I want to start maybe with your views on what is happening in terms of valuations in the private market with your remit, of course, within the VC world. What are you seeing in terms of valuations? Are we starting to see a bottom? Are you starting to feel a little bit more optimistic about where things could be turning in terms of the tech sector more broadly?
Yes, well, this is a very difficult question to answer, of course. When do we finally reach the bottom? The venture business takes its sort of anchor valuations from NASDAQ. And of course, NASDAQ has been down badly, as you've just heard, and so have venture valuations. The big advantage in the venture world is that we can take a much longer term view because we do not have public valuations. So our funds are typically 10-year funds, so we can take much longer term views.
Hermann, is there a particular sector that is kind of keeping you up at night, that is exciting you at this point? I know you have exposure to everything from fintech to health tech to biotech. Is there an area that is really causing and generating a lot of excitement for you and the team at Amadeus at this point?
Yes, indeed. And it is quantum computing and synthetic biology. The quantum computing is actually even more short-term than synthetic biology because we're beginning to see the first really encouraging results from our quantum investments, of which there are quite a few. And SynBio is a longer-term theme because it affects our health directly.
And in terms of your portfolio companies, Hermann, as we look at a tighter rates environment, or at least a higher rates environment and slightly tighter economic conditions, what are you seeing in terms of the portfolio companies and the need for them to address cost cutting? Are you seeing that pressure on some of these companies? Are you having words with some of your team, your executives who you've invested in and saying, look, you need to cut some of the fat, maybe slow hiring? Is that a stage where you're at?
Yes, we are. And of course, this is not the first time we've been through this. We've been through 4 such recession periods, if indeed we do get a recession. And it is an issue of a belt tightening, but most importantly, it's a period where cash is king. We just have to make sure that companies have enough cash to weather the storm.
Okay, cash is king and belt tightening is where we stand. Hermann, it would be remiss of me, of course, not to ask for your views. You've been very outspoken on the question of ARM, of course, and your historical links to that company as we discuss those SoftBank earnings. Has the UK lost the opportunity now? They've paused their IPO discussions, they say, because of political uncertainty here in the UK. Has that ship already sailed? Or do you have some optimism that we can somehow convince them to list in the UK?
I don't think the ship has sailed. I think there is still an opportunity to get a dual listing. We did have a dual listing, of course, before SoftBank took over ARM. I have no official relationship with ARM anymore. I had to sell all my shares during the SoftBank transaction. But as you probably heard, the latest results out of ARM are really very positive. So I think there is a good chance that the IPO will happen sometime next year. And I very much hope that it will be a dual listing in London and NASDAQ.
Well, we will continue to watch that story. And Hermann, I know you've been thinking deeply about the question of sovereignty within technology and the technology space. We look at the geopolitics right now of China and Taiwan, and of course the question of the role that US plays and European spending, of course, on things like semiconductors. Where does that lead you? How well resourced is the UK, the private sector and the government to build up some form of sovereignty when it comes to the essential needs of technology?
Yes, I'm very concerned about technology software, so much so that I'm writing a book on it. And in my opinion, there are going to be 3 technology sovereignty circles, the US, China, and Europe. And as regards to Britain will have to decide on which of the 3 to join. And I expect it doesn't want to join China. I hope it doesn't want to become the 51st state of the US. So I hope that despite the toxicity of the Brexit idiocy, Britain will again link up with Europe to become sovereign, because there is no way in which Britain alone can be technology sovereignty. It lacks 5G technology, it lacks the semiconductor industry, two out of many critical technologies that you have to have in order to claim to be technologically sovereign.
What should the government response be? What should the policymaker response be then to those needs to align with what is happening on the ground? And you're there at the coalface from the private sector. What is needed to accelerate that shift?
Well, we need to have a closer link to Europe again, to have access, guaranteed access without political strings either from China or the US. We've got to have closer links to Europe. And as you probably heard, Europe is making a phenomenal effort to bring the semiconductor industry back to Europe, mainly from Asia, and spending 145 billion to do so, with an aim of having 20% of the semiconductor spend in semiconductor capacity in the world back in Europe.
Hermann, we started the conversation on the question of the private markets. So let me end it with the public markets. And if you have any sense, any clarity as to when your portfolio companies might be listing or looking to list, the pipeline then for IPOs, are we going to start to see that in the second half of this year, or is it too early still?
I think it might be a little bit too early this year. The hope is that a number of our companies will actually IPO sometime next year, unless, things like the Ukrainian war are really out of hand, or other very dramatic things happening. So I do have hope next year we'll see green shoots in the technology space again.
I would say, OK, looking for those green shoots in the tech space in the early part of next year. Hermann Hauser, fascinating insights. Thank you. And we should get you back on to talk about that book on sovereignty, tech sovereignty, when it comes out. Co-founder and venture partner at Amadeus Capital Partners. Thank you. Coming up, Ukrainian officials say Russian forces shelled the area around Europe's largest nuclear plant for a second day. More on the war in Eastern Europe and those risks next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Let's get back to what's happening in Ukraine now. Ukrainian officials say Russian forces shelled the area around Europe's largest nuclear plant. That was for a second day. The attacks happened hours after the head of the UN's Atomic Safety Agency warned of what it described as, quote, potentially catastrophic consequences. Moscow has denied targeting the plant. For more, we are joined by Ross Matheson. Ross, how significant, how real are the risks of a nuclear accident or a nuclear incident as a result of this shelling?
Well, this has been a running theme through this conflict so far because, of course, as you pointed out, Ukraine is home to some of Europe's biggest nuclear power plants, multiple nuclear power plants, of course, the most famous one being the defunct Chernobyl power plant. And there's been fighting in and around some of these plants throughout the conflict. This is particularly one that's concerning at the moment because it's occupied by Russian troops but run by Ukrainian officials and seemingly in the line of fire again. And whenever you have shells landing around spent nuclear fuel, you know that that's a recipe potentially for disaster. To your point about whether this is a disaster in the making, the question is, well, that's really up to Russia to decide to some extent, because if they're willing to use it as a pawn in their conflict with Ukraine, they could push the envelope in terms of further attacks in and around this plant, or using it as a base to stage attacks outward. And then, of course, you could even get the risk of an unintended accident as a result of this, which would have enormous potential consequences for the environment, for those in the area, and so on. So we are looking at some high risk here.
And Ross, the Russians, Moscow says they've denied that they are responsible for this shelling. Do we take them at face value on that? Do we believe them? And if they are responsible for it, what is the strategy, given that it seems, given the proximity of the border, that Russia would not be immune itself to the fallout from any nuclear disaster?
Well, that is the question. Of course, it's a bit of a he said, she said. Russia says that Ukraine has been doing this shelling that went on for 2 days. Thankfully, no further reports of shelling in the area. This morning, Ukraine says Russia is essentially shelling itself because its troops are, of course, occupying this plant and working out of the area. The question is, why would Russia essentially decide to shell itself? One would be the possibility that some of this has happened by accident. Of course, there are reports that a lot of the artillery at least hasn't been perfectly targeted so far in this conflict. It's possible some of this stuff just went awry and landed in the wrong place. But also it could be a warning from Russia to Ukraine. We will use this if needed against you. Of course, there are big reports that Ukraine is girding up for a counteroffensive further south near Kherson. But perhaps it's a warning to Ukraine. We can still come at you in various ways even if you try and attack us further in the south. So certainly possibly a warning shot to Ukraine in that regard.
And Ros, more broadly, and you touched on this, where do things stand in terms of this conflict, the progress that's being made by Ukrainian forces, and indeed what is happening with Russian forces in the Donbass region?
Well, essentially, we're 6 months into this conflict, and a lot of it has largely ground to a halt. There's fighting still going on in the east. Russia is making further advances around Donetsk, which we saw reported again in the last 2 days, but it's sort of literally almost yards at a time at this point. But basically, the longer Russia can occupy that area, the more it becomes a status quo that they're there and they're there to stay, of course, in the run-up to possible referendums in those areas to annex them. So that's a big question, just to stay there in that area. The question is, there's lots of evidence that Ukraine is pushing its troops into the south and Russia is having to send its own troops south as a result, possibly to fight off a counteroffensive, but also that's just to draw Russian troops away from the east and to further bed them down. So we're basically looking at a long-running war of attrition that could go on for quite some time yet.
OK, Ros Maddison, Bloomberg's senior executive editor for government, on the latest in terms of that conflict and, of course, the risks around the nuclear plant. Thank you very much indeed. Let's get your Bloomberg Business Flash now with Leanne Gerrans. Leanne.
Hi, Tom. Veolia has agreed to sell Suez waste activities in the UK to Macquarie Group for €2.4 billion. Veolia bought a large part of its French rival Suez waste assets earlier this year, raising antitrust concerns here in the UK. The disposal will mark the last step in Veolia's acquisition of a large part of Suez. Now, Telecom Italia's CEO says the company is focused on fully spinning off its landline network, though it has not ruled out an alternative plan for its most valuable assets. Pietro Labriola told an Italian newspaper that the former state monopoly may also explore a separate landline network with a financial partner as a plan B. Carlyle Group Chief Executive Kusong Lee has stepped down. Co-founder Bill Conway will serve as interim CEO, which is effective immediately. The US private equity giant has formed a search committee to find a permanent successor and a CEO office to assist Conway and help make what it calls a seamless transition for the person who eventually takes the job. Loomis Sayles has sued Citigroup, alleging the bank has caused more than $70 million in losses while executing two separate trading orders that swamped the market. The investment firm says Citigroup was serving as its broker in the purchase of Spotify shares and the sale of Colgate and Palmolive stock. Citigroup has declined to comment. And that's your Bloomberg Business Flash. Tom.
Leanne Gerrans, thank you very much indeed. Coming up, energy comes into focus as oil and renewable companies report this week. We are going to look at what to watch next. This is Bloomberg. Welcome back. Happy Monday. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. We've been talking about the Softbank story after that record loss, of course, for Masayoshi Son. We've got a redhead crossing the terminal now. The CEO saying he is in talks to sell Fortress, which is a hedge fund. He's in talks to sell Fortress, the hedge fund. This after Softbank announced that it's going to do a group buyback of about 6.3% of its shares for 400 billion yen. But the latest redhead is that the CEO, Masayoshi Son, is looking to sell the hedge fund Fortress. We'll get, if we get more lines, we'll of course bring those to you. Right, one thing we are watching out for this week, beyond Softbank and the earnings out of that company, of course, are the earnings of energy companies. The fossil fuel addiction, the race for renewables, and the costly impact of climate change will be in focus among corporate reports we are expecting. Telecoms and gaming companies will also feature. Let's take a closer look then with Bloomberg's Charles Capel. And Charles, the energy crisis, of course, emerging as central to the earnings picture. And we've saw the stellar numbers for the likes of Shell and BP. And that trend presumably is going to be continuing.
Exactly. We know that Saudi Aramco, the world's largest oil producer, when they report on Sunday, their earnings are going to be huge. But the thing we're going to be looking out for is the capital expenditure on production, especially after that, albeit very small, OPEC increase. So that's going to be really interesting, as well as any comments on the market. On the energy side, the other thing we're looking out for is RWE. That's the German energy provider. They have already boosted their profit expectations for the full year. Let's see how they do in the second quarter. And then finally, we're going from fossil fuels to wind turbines, and the world's largest wind turbine producer, Vestas. Now, they've been hit by high steel prices across the entire industry, as well as some supply chain disruption. They're expected to post a loss for this quarter, but they are so important now, especially as the energy crisis is revealing how reliable we are on importing hydrocarbons. If we can increase that domestic wind turbine production, then that will massively help European companies become energy independent. But they have had some of those supply chain issues, so certainly one to keep an eye out for.
OK, so Saudi Aramco alongside the Danish company as well, Vestas, amongst the mix, and RWE, of course, a utility company in Germany. And as you're talking about the earnings pitch, and we focus on the telecom sector and Deutsche Telekom and what that's likely to tell us about the health of that market.
Exactly, yeah. It's the telecoms industry, particularly their business-to-business unit, which I think investors should be really looking into. It may well reveal some of those macro headwinds. Now, if companies are holding back on some of the investment, some of the spending that they might do in order to improve their telecoms infrastructure, that would be really interesting. If you look at BT, which reported previously, they said there was a softening in their enterprise unit as some of those companies were holding back on that investment. But then on the other side of things, the US telecoms market seems relatively robust. T-Mobile US upgraded their guidance. Deutsche Telekom obviously owns about half of T-Mobile US. That makes up about 40% of their sales, the US sales. It's about 40% of Deutsche Telekom's sales. So it'd be interesting to see whether the management chooses to raise expectations a little bit there.
OK, Deutsche Telekom and the business-to-business units focusing on. Charles Capel, thank you for walking us through some of the key earnings to watch this week. Talking of earnings, Berkshire Hathaway's bottom line was punished by the market rout in the second quarter. The conglomerate posted a net loss of $43.8 billion US. Berkshire Hathaway's various businesses are seen as also a reflection to some degree of the broader US economy. Here to join us and break down these results is Bloomberg's Laura Wright. Laura, what stood out for you then from the earnings from Berkshire?
Well, the loss was down to the decrease in value of Berkshire Hathaway's equity portfolio, which is included as a component of earnings. But if you exclude those market fluctuations, then operating earnings were actually up 39% year over year. Berkshire Hathaway adopted a buy-the-dip mentality with net equity purchases of $3.8 billion. Share buybacks, $1 billion, slightly less than the previous quarter. Warren Buffett's philosophy that cash is king, or the cash pile, basically unchanged, $105 billion. And you can see year-to-date an outperformance of Berkshire Hathaway compared to the S&P 500 benchmark.
OK, Laura Wright, thank you very much indeed with the details in terms of Berkshire Hathaway. The gains that you're seeing here in Europe, 0.4% future stateside, pointing to gains between 0.2 and 0.4. Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller, Kailey Leinz and Anna Edwards in London. Stay with us. This is Bloomberg.
Right now, we're not seeing the economy going over a cliff, and this is exactly the time that the Fed needs to be moving quickly.
There is this path to a soft landing. I don't see why people think it's such an elusive thing.
The Fed is trying to engineer all of this, and we can see areas of the economy where they're very successful and areas where they need to continue.
The market seems to be more convinced that inflation is close to a peak.
There's some fear of missing out happening here after a brutal first quarter. But, I think we can all agree that reality, the fundamentals haven't gotten any better.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. The Senate gives President Biden something to cheer about. It passes a slimmed-down version of his tax, climate, and health care bill. A stunning development at Carlyle Group. CEO Kyu-Sung Lee unexpectedly steps down, reversing the private equity giant's changing of the guard. And Warren Buffett buys the dip. Berkshire Hathaway takes advantage of the stock market slump to scoop up stocks. Good morning. Welcome to Bloomberg Surveillance, the early edition. I'm Danny Berger in London, in for Anna Edwards, alongside Matt Miller and Kailey Leinz in New York. And Kailey, perhaps still some digestion of that stunning jobs figure on Friday. But I gotta say, it does seem like resilience in Europe and the U.S., perhaps not exactly with Asian equities.
Yeah, you really saw that follow on from the Friday price action in Asia overnight, in that the market expectation is now a more aggressive Federal Reserve, considering we got an absolute blowout on that payrolls number. So that really weighed heavily on Asian sentiment. On the more positive side, you did have a record trade surplus out of China. You also have some easing of the hotel quarantine period in Hong Kong, but none of that was really enough to lift sentiment. The MSCI Asia Pacific Index overall down just a little bit more than 0.1%, but some real underperformance coming from the likes of technology stocks, big Chinese technology stocks, with the Hang Seng Tech Index down about 1.8%. Following on from that underperformance we saw in technology here in the U.S. on Friday. In other asset classes, you see that more aggressive Federal Reserve hike playing out in currencies. For example, pretty much everything in Asia is weaker against the dollar today. One of your big underperformers, the South Korean won, weaker by about 0.6%. And in the bond market, we saw that continued selling pressure in the Asia Pacific region. In Australia, you definitely saw that in the belly of the curve. The 5-year yield there up 13 basis points overnight, Matt.
Yeah, we're still looking at gains here in terms of futures after a mildly negative end to the session on Friday. Still, we were positive for the week on the S&P. Now we're looking at S&P futures up about 0.25%. And it's the 2s-10 spread that I really want to focus in on here right now. Down at negative 41 basis points. And we were even down at negative 44 on Friday. But that jobs number just continues to reverberate through markets, even though financial conditions continue to loosen. NYMEX crude, as one example, coming down 77 cents a barrel to 88.24. We had gone up over $90 a barrel, and now we're back down under that, giving a little bit of a tailwind to risk assets. And Bitcoin right now up about 4%, 24,161. So it looks like it may start moving away from that 20,000 range and getting back up a little bit. Some gains there, Danny, for the digital currency. What do you see in Europe?
Well, Matt, it's interesting because Kailey was mentioning how that Asia session was following on from the weakness in the U.S. session on Friday. Usually Europe does the same, but it is not today. It is continued strength. It is continued resilience, perhaps buoyed by some strong corporate earnings, or at least not as bad as expected. So we're looking at gains across most regions. Technology shares, those leading the pack, again, despite some duration fears. Italy, that is underperforming. It is flat today on a day when most stocks are up by about 0.3%, or benchmarks rather. The center-left coalition there in Italy falling apart. The political drama continues. But that does mean on a headline basis, we are moving higher in European stocks. Perhaps it does have some to do with what you were saying, Matt, of oil moving lower. We're seeing that in the Brent crude price as well. That's at $94 a barrel, down 0.8%. I should flag we are seeing Iran nuclear talks starting yet again. So that's another possible risk to put oil, again, the pressure downward on that. I also wanted to point out BTP's 10-year yields on Italy not doing much this morning. We seem to have avoided potential implosion after Moody's downgraded the sovereign debt. It is currently just one step above sub-investment grade, but still we're not seeing massive selling there. Indeed, we're seeing buying today. Finally, wanted to point out Siemens Energy. I spoke to the CEO this morning after they reported their earnings. It really exemplifies the strangeness of being an energy company in today's environment. He said their order backlog is really, really strong. There's so much demand there. However, it's high material prices for their wind turbine unit, and at the same time, it's costs related to Russia restructuring. That means that they've had to downgrade their full year outlook. So, Kailey, those shares down nearly 2.5%.
Yeah, definitely a theme we will continue to keep an eye on as we weigh the energy crisis on the one hand and ongoing supply chain issues that are feeding into that as well. Now, there is a lot going on this week, so make sure to buckle up. Starting with Kenya, heading to the polls tomorrow for one of the closest elections in the nation's 30-year-old democracy. But really, the big figure comes on Wednesday. U.S. CPI data will come that day, a vital inflation print, especially after the strong payrolls report of last week. We'll also get inflation data out of China on Wednesday. OPEC Plus will be releasing its monthly oil report on Thursday. And then rounding things out at the end of the week, we'll see the impact of sanctions on Russia's economy with second quarter GDP on Friday, Matt.
All right, so a lot of data coming up, but especially inflation. All eyes on that. The Senate has passed a landmark tax, climate, and health care bill, giving President Biden a victory on his domestic agenda. Senate Majority Leader Chuck Schumer spoke yesterday.
We had many bumps in the road, many times when it looked like it would never happen, but we never gave up. And here we are. We got it done.
Jack Fitzpatrick of Bloomberg Government joins us from D.C. Now, Jack, we call this a landmark piece of legislation, but it was slimmed down to from $6 trillion to less than, I think, 400 or 500 billion. What did they actually achieve here?
Yeah, it was a lot less than if you compare it to the conversation a year plus ago when you heard what people like Bernie Sanders were pushing for and some of the original talking points from the Biden administration. But this is a significant one. It got the 15% corporate minimum tax rate in there, a 1% stock buyback tax in there. It raises more than $700 billion in revenue over the next decade and then spends about $400 billion of that, almost $400 billion on tax credits and spending for clean energy. There's also the measure that would allow Medicare to negotiate some prescription drug prices. So there's a prescription drug price measure that's supposed to reduce drug prices on Medicare. So ultimately, you've got $700+ billion in revenue, about $400 billion in spending, largely on those clean energy issues, and then it would reduce the deficit by about $300 billion, a little more than $300 billion over the course of the next decade. So that's the big checklist that Senator Joe Manchin was looking for, is reduce the deficit, also get into some of the clean energy issues and prescription drug pricing for Medicare.
Jack, let's get into some of the geopolitical issues that Washington is facing. We have China signaling that military activity around Taiwan, that is continuing past a series of drills, of course, announced in the wake of House Speaker Nancy Pelosi's visit. Taiwan's representative to the U.S. spoke on CBS yesterday. Take a listen, Jack.
The Beijing government is currently trying to manufacture a crisis over a practice that has been ongoing for decades. It's really up to Beijing to decide if their rejuvenation, if China's rejuvenation will evolve with international respect or with international condemnation.
Jack, what sort of position does this put Washington in if we continue to have these exercises from the Chinese military around Taiwan?
Well, it puts the U.S. in a difficult position, especially because, for one, in the lead up to this, there was a bit of a division between the Biden administration and Speaker Pelosi on whether it was actually a good idea for her to make that trip to Taiwan. And of course, the broader context now is that China initially indicated that these drills around Taiwan would happen for 3 days, ending Sunday, and now this is an extension of that. They haven't provided a lot of details of how long they will extend this. They said that they were doing more on Monday. They described air-to-sea anti-submarine practices, and meanwhile, Taiwan officials said that they also saw a Chinese presence around its territory in a way that was not announced alongside that. So they're not getting all the details from Chinese officials in terms of the extent of these practices and how long they're going to go. So for now, they're sort of stuck in a murky area, just knowing that China is extending it and escalating their pushback, especially in that context of Speaker Pelosi's visit to Taiwan.
All right, Jack Fitzpatrick of Bloomberg Government with the latest on both foreign and domestic policy. Thank you so much. Let's turn now to a surprise change at the top of private equity giant Carlyle Group. CEO Kusan Ling has stepped down. His 5-year employment contract was due to expire at the end of the year, and Bloomberg has learned that Lee and Carlyle's board had clashed over the contract in recent discussions. Sonali Basak, Bloomberg Global Finance correspondent, joins us now with more. So, Sonali, this was unexpected, especially an announcement late on a Sunday night. Clearly a big deal for Carlyle, but does this go beyond them?
Listen, Kailey, Carlyle was really the first company that we know of this generation to hand over the reins in the first place. And Kusan Lee is stepping down before his contract is even over. What we have learned is that the board met over the weekend and in recent weeks. And yes, this really came down to contract negotiations from everything that we know. Now, how smooth of a transition can all these other companies make is the question. You look over at Apollo, Mark Rowan is a co-founder of the firm. You look over at Blackstone, you do still have Steve Schwartzman at the helm. So yes, these generational changes, the ability of these firms to move and pivot quickly is a key question here as they have grown so fast and so large.
I mean, contract negotiations sounds calm, almost boring, right? When you tell me someone announces the CEO is leaving on a Sunday night at 10 p.m., I think there must be something more acrimonious.
Listen, I've been on the phone since 1 in the morning, okay, from everyone from India to London. So yes, this has definitely shaken the investment universe. Let's not be coy about it. 10 p.m. Eastern on a Sunday night. And remember, like I said, he is stepping down before the contract is even up. So this was dramatic. It wouldn't have been the first power struggle, for example, that we've seen over at Carlyle. The board has not yet named an executive search firm, according to the release that they put out last night. So there's a lot of suddenness behind the way this was announced, and very unusual from anything from a large corporation, let alone Carlyle, which tends to tie up a lot of loose ends in the way that they communicate with investors and the press. So yes, absolutely, this was a very strange way to announce a massive leadership transition. I would also say there's a lot of history here. Remember, he took over not only did he take over in 2018, he took over
with Glenn Youngkin,
exactly.
and then Youngkin obviously left to be governor, and so he took over solely like 2020, right?
Exactly. So one of the main questions I have now is when they look for a successor this time around, is it going to be internal or is it going to be external? This is a company that in the last 6 months alone, credit assets have doubled. So the texture of the firm is changing very, very quickly. All of its rivals are starting to find new sources of fundraising in wealth channels and otherwise. So what does a new CEO of Carlyle look like is, I think, a pivotal question.
All right, Sonali, thank you very much. Bloomberg Sonali Basak there, putting in the early morning hours. Go take a nap or something soon. Thanks so much. All right, now to Softbank, which has reported a record $23.4 billion quarterly loss. That has a sell-off in global tech stocks continue to hammer its Vision Fund's portfolio of investments. Let's bring in Bloomberg's Charlie Wells. Charlie, look, a lot to dig through. I mean, generally, not the best of news. What does this mean for Softbank and Masayoshi Son's ability to right the ship?
Yeah, so Danny, it's pretty bad, and I would say it is medieval Japan bad. That is the theme that Son brought up in a very dramatic press conference that ended just a few moments ago, in which he compared himself to a 16th century shogun, Tokugawa Ieyasu, who lost a humiliating defeat, and I feel like that is the sentiment at Softbank right now. Son, in this press conference, indicated that 60% of portfolio companies in that Vision Fund had seen their valuations drop, and that tracks with what we've been hearing over the past few weeks about Klarna dropping from a valuation of about $40 billion to $10 billion, ByteDance going down about 25%. So what investors will be cheered by is a $3 billion buyback program that was also sort of a surprise announcement today. And they will be hoping that Son can right this ship and continue that theme he made to that shogun who ended up, after this defeat, uniting Japan.
All right, Charlie, fascinating story. Charlie Wells there talking to us about the massive losses at Softbank. Let's talk about Berkshire Hathaway. The bottom line there was punished by the market rout in the second quarter. The insurance, railroad, and utilities conglomerate posted a net loss of $43.8 billion, even more than Softbank. Let's get more at Bloomberg's Laura Wright. Laura, what's the street going to be thinking about these results?
Well, in short, the street won't be disappointed by the Oracle of Omaha because the loss was down to the decrease in value of Berkshire Hathaway's equity portfolio, which of course is included as a component of earnings. Now, for Warren Buffett, this can be extremely misleading because if you exclude those market gyrations, then operating earnings were actually up 39% year over year. Berkshire Hathaway became a net buyer of equities, purchasing $3.8 billion worth, a buy-the-dip mentality present there. The cash pile was basically unchanged, $105 billion. For Buffett, he believes that cash is the oxygen of this holding company. Share buybacks saw a slight reduction from the previous quarter of around $1 billion. But overall, Berkshire Hathaway has outperformed the S&P 500 year to date, experiencing losses of 2.5% compared to steeper losses of 13% on the wider benchmark. But Berkshire Hathaway, as we know, is seen as a microcosm of the broader US economy. And I'll run through a few examples that illustrate this. Geico is the auto insurer. That business experienced a loss of nearly $500 million. It is so much more expensive now to replace or fix damaged vehicles. BNSF Railroads, this operates in 28 states. They had to impart a fuel surcharge on their clients to cope with their exorbitant fuel costs. Clayton Homes, this is a modular home unit maker. The expectation is that demand will cool here when mortgage rates increase because of Fed hikes. And I've included Occidental Petroleum here. Berkshire Hathaway are the largest shareholder in the energy giant, an astute choice when the company is the best performing stock in the S&P 500 in 2022.
All right, Bloomberg's Lara Wright, thank you so much. Now, let's get back to pre-market action here in the U.S. and take a look at some of the stocks on the move. And I have to begin with Bed Bath & Beyond, because this is kind of a weird one. The stock already is coming off of its longest winning streak since 2007, up 8 days in a row, up 77% over those 8 days. And it is continuing this morning with the stock up more than 12%. No real reason why, but it is getting cited a lot on StockTwit, so it does look like it may be a bit of meme action for this stock in particular. You also have crypto on the rise. Bitcoin is north of $24,000, and that's giving a lift to crypto-related equities in early hours, among them Coinbase, the big crypto exchange, up about 4.6%. And also moving higher as a group really is anything related to clean energy, solar power, those kind of energy production investments after we got the passage of the Inflation Reduction Act, which of course involves clean energy spending in the Senate over the weekend. So the likes of Sunrun are higher by about 2.8% before the bell, Danny.
I should say they're doing well in the U.S., but in Europe, seeing some pain after those Siemens earnings, which sparked concern about high material costs and what that means, at least for European wind turbine makers. All right, coming up on the program, we'll be speaking with John McClain, Portfolio Manager at Brandywine Global, on the risk to credit after an MLive survey indicated more pain to come. And later today on Bloomberg ETF IQ, Matt Miller will be speaking to investor Kathy Wood. Not just Matt, I should say, Katie Greifeld and Eric Balchunas. That will be at 1 p.m. New York time, 6 p.m. in London. That's one not to miss. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz in New York and Danny Berger in London. Now, we are awaiting a big inflation print on Wednesday that could really move markets. And we're looking to see a lessening of inflation in terms of the headline number from the June figure, but maybe not in terms of the core number. Tatiana Derry is here from Bloomberg Markets Live to talk about what we can be expecting, what we can be looking for. And Tatiana, it's really, as the chart says, not all about gas prices, because they have come down.
Exactly, Matt. Yeah, like you said, they have come down, and that's going to bring down the headline number to below 9%, according to economists. But do watch the core. That number is expected to tick up above 6%, and Bloomberg Economics is warning of a 7% rate here in the coming months as areas like rents and and medical services prove sticky and remain high for longer. So I think markets are unprepared for that. I mean, if we're talking about a 7% on the core reading, that is not on traders' radars right now. That also, highlights yet again, serves as a reminder that the inflation fight is far from over. And on top of the strong jobs number, that will just probably boost some of those rate expectations for 75 basis points in September. We already see that probability at 80%. But now there's even chatter about an inter-meeting hike. And I think that could accelerate if the magnitude of the surprise is large.
Yeah, that September meeting is still a very long ways away, which could make Jackson Hole even more interesting. As far as what would be, do you expect that it will be a bigger catalyst for the equity market, which has rallied substantially over the last month and a half, or the bond market, where yields are much lower than they were?
Exactly, Kailey. Well, I think it's interesting because we already saw some action in the bond market, right? We saw the huge losses on Friday, and that perhaps is a preview of what's yet to come. With not so much for stocks, right? We saw some of the sell-offs, but pretty much ended unchanged on the day. And I think traders are just trying to balance out what a strong jobs report means for the economy overall, what it means for the consumer, for their profits. So if earnings, hold up better than expected, perhaps the magnitude of the losses won't be as high. But when you look at Bed Bath & Beyond, or AMC rallying 20%, right? That is telling you the Fed has a communication problem. So perhaps, more to come there for stocks.
All right, Bloomberg M Live's Markets Live, Tatiana Dari, thank you so much. And of course, for more market analysis, you can check out MLIV Go on your terminal. This is Bloomberg. The Fed pushback continues. San Francisco Fed President Mary Daly suggested a 0.5 percentage point increase isn't locked in at the September meeting. Daly told CBS News the central bank is far from done in bringing down inflation. A strong jobs report on Friday bolstered support for another 75 basis point rate hike by the Fed. The market now pricing in about 80% probability of that. But of course, Wednesday's CPI print going to be absolutely crucial. So we'll discuss the implications for credit markets with John McClain, Portfolio Manager at Brandywine Global, coming up next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The Senate gives President Biden something to cheer about. It passes a slimmed-down version of his tax, climate, and health care bill. A stunning development at Carlyle Group. CEO Kyu-Sung Lee unexpectedly steps down, reversing the private equity giant's changing of the guard. And Warren Buffett buys the dip. Berkshire Hathaway takes advantage of the stock market slump to scoop up stocks. I'm Danny Berger in London alongside Matt Miller and Kailey Leinz in New York. Anna Edwards is off this week. And Matt, it's not just Berkshire Hathaway. It seems plenty of people happy to buy the dip. That despite that very strong unemployment figure on Friday, that has to have people thinking, can the Fed really afford to pivot down the line?
Yeah, and the Fed keeps telling us that's not what we're going to do, but the market doesn't seem to believe them. In terms of what we're seeing here ahead of the trade, futures are up almost 0.25% right now. There could actually be some relief in this. That the tax bill didn't really, raise taxes. So that's good for markets, right? We see the 2s, 10s now inverted at 41 basis points, negative 41 basis points. It was negative 44 on Friday. This is the biggest inversion that we've seen since the year 2000. So that portends a recession coming. Nonetheless, financial conditions are loosening. And here's a good example of that. NYMEX crude is down another 48 cents a barrel. It's 88.53, now down under $90. It had eclipsed that level for a long time, come down briefly, then back up, and now we're back down. So this makes things easier, basically, for consumers and businesses to operate. And then Bitcoin right now up almost 4%. So this is a very correlated asset. If Bitcoin investors are this happy, you could see risk assets climbing even more. So 24,147 is what we're seeing here. Kailey, what do you see in terms of pre-market movers?
Well, tied to that move in Bitcoin as it rises to the highest level in almost 2 months, a lot of crypto-related equities are moving higher in pre-market trading. The likes of Riot Blockchain and Marathon Digital, each up more than 6% at this point. And another basket of stocks moving higher is anything related to solar or clean energy supply after we saw the passage of the Inflation Reduction Act in the Senate over the weekend. Of course, a lot of clean energy spending, even if it wasn't as much as previously desired, is involved in that bill. So that's lifting the likes of First Solar and Plug Power each up about 3% before the bell, Danny.
Well, you also have European stocks powering higher, a little pun, if I may, in Europe as well. Up 0.5%, 0.5% for the European stock 600s. Again, it's this resilience. Tech is doing well despite fears of higher interest rate increases. Also, Bank of America, the team there with Seb Radler, saying that they are downgrading their look on European stocks. There is just too much macro risk. So they see that, the market not pricing that in at the moment. Matt showed you New York crude. I'm showing you Brent crude. That's also down more than 0.5% as well. So again, feeding into this more positive market environment. Also looking at Italy, the risk there that we could see the yields blow out, that hasn't quite happened. Yes, we are back to selling, but ever so slightly, not even 1 basis point. That follows on from Moody's downgrading Italian sovereign debt. It is now just 1 step above sub-investment grade, but perhaps hopes that the ECB will step in to save the day. Anti-fragmentation tools and whatnot isn't allowing the worst of what could happen to happen at the moment. Finally, Siemens Energy here reversing some of the worst of their losses. Perhaps it has to do with that story Kailey was talking about with wind turbine makers doing better after that U.S. Senate bill. It was unchanged. Now it looks up to be 0.3%. So some volatility there. Not totally sure what's happening, but it was down pretty dramatically to start the session, given earnings were poor, given issues with Russia, but seeming like it's able to eke out some gains this morning, Matt.
All right, very interesting stuff and a lot of tailwinds. Let's talk about headwinds right now. The latest MLive Pulse survey asked about the greatest risk in credit markets. Here's how investors responded.
Geopolitical risk is always difficult to navigate simply because it tends to come from left field. However, it's part of investing.
The only thing that's ever really protected us is having very diversified, very global portfolios. And so at Carlyle, what we've been doing is actually taking advantage of a broad platform that we have all the way from liquid to illiquid credit.
I think it's more a case of staying away from those cyclical type of exposures where the macro fundamentals could potentially deteriorate with the recession on the horizon in Europe.
When you're doing credit risk modeling as a business, you need to increase it so you essentially eliminate your downside risk. So it's going to be a very, very complex market we have to deal with in the coming months.
Joining us now is John McClain, Brandywine Global Portfolio Manager. And John, the credit markets have been very interesting to watch lately. The volatility has been just off the charts. What do you make of the greatest risks, or what do you think are the greatest risks for the credit market in the second half?
I mean, how much time do we have here, really? You got geopolitical is certainly very large here. I think valuation risk, valuation's kind of neutral now. It was reasonably cheap, a month ago, and so valuation risk certainly. And I think that really the market has misinterpreted the Fed's message, and I think you were mentioning earlier, the Fed is not happy with the market interpretation of a pivot here, and we've seen the speakers coming out time and again mentioning that we're not done yet. So I think that inflation is sticky, and it's going to be very difficult to bring down, and markets need to readjust.
If you're a bond investor, are you, selling debt because rates are going to rise and you can get a bigger yield later, or are you buying debt and preparing for, especially governments, right, and preparing for a recession?
Well, it's challenging because liquidity in the marketplace is fairly challenging. What we're trying to do right now is, bulletproof our portfolios to be able to deal with a higher inflation type of environment for a persistent amount of time frame here. And actually, that's one of the reasons why we like high yield. That seems maybe a little bit counterintuitive, but if you think about an inflationary recession, your assets are going up in value, your liabilities, your fixed rate debt liabilities are going down in absolute, not nominal amounts here. So as long as you can pay your coupon, pay your interest payments, and make sure that you can refinance, then we think high yield's an interesting place to be right now.
Yeah, and you're speaking, to positioning for this interest rate risk, but what about default risk, John? How concerned are you?
Yes, I mean, we're kind of taking this Goldilocks approach here of a little bit of credit risk and a little bit of duration risk. but not too much of either. And on the credit side of things, really this triple C part of the market, we do think that there's enhanced default risk. A number of strategists have kind of come out and talked about this over the past couple of months here. We certainly could see elevated defaults in the triple C part of the marketplace. We also think that from an asset class perspective, the leveraged loan and private credit parts of the market are bearing too much risk right now, because as interest rates move higher, the majority of that debt is floating rate in nature, and so that really impairs the ability of those companies to make their interest payments. So what we would say is the sweet spot of the marketplace really is kind of from single B on the low end to low triple B on the high end.
You do point out, which is something that Bank of America points out, this idea that the U.S. high-yield issuers have crushed it this earnings season. In general, it's been a very strong earnings season. Does that mean some of the risks which many foresaw coming, which gave us this negative view heading into corporate reports, was it just unfounded or is it just delayed?
It's just delayed. It's slower to play out. Certainly, we thought that 2Q earnings were going to be weaker than they came in, and they absolutely did crush it in high yield. And that's one of the things we've tried to talk to investors about, is saying that, look, if you're looking at U.S. high yield, about 80% of that revenue is domestic, and certainly we like the U.S. relative to the rest of the world from a standpoint of economic fundamentals. And then you've got a lot of commodity exposure there as well. So energy's finally a tailwind for the asset class as opposed to a headwind. So, what I think we're going to see is really this delayed reaction in terms of earnings. We've had sectors like home building certainly has been weak. The retailers are on deck, and I think we'll have, fairly challenging numbers there. So I think it's really 3Q. You're going to see start to see a slowdown in terms of earnings, and really the guide going forward is going to be what the market should be focused on.
As we move forward as well, what are your expectations for issuance? We've seen just in the last couple of weeks, big tech companies like Meta and Apple with some pretty sizable offerings. Meta's first one ever. Do you expect we're going to see more supply?
Absolutely. I think that companies have had the luxury of being able to wait out this market where they didn't really like the borrowing costs. And so what we're going to see in high yield, I think, post-Labor Day is a lot of issuance coming into the space. Year to date, we're down about 80% in terms of issuance. And that was really the story of the first 7 months, was no demand for the asset class, no supply. Now I think we're going to start to see some companies strategically come to the marketplace. Certainly we have some, LBO debt that needs to get done as well. And then in investment grade, the banks have really been the ones driving issuance there. They're for the most part done, but certainly as borrowing rates have come down a little bit here, I think we will see some more investment grade companies coming to market as they see a little bit of a window here.
But what kind of demand do you think they will be met with if we're talking about an even softer macro environment a couple months from now?
Yeah, well, so, I mean, that's kind of the thing, is there's so much capital on the sidelines, and that's at the end of the day what prevents really the disaster here, is that, there is a lot of capital sitting on the sidelines and waiting for entry points. And I think in high yield, as an example, we really saw where that line in the sand was, which was probably around 9% and around 600 basis points. So if we widen out at all, the valuations will look compelling and money will come in. I think on investment grade, we're a little bit further away from that. I would say that, really what we think is low 200 spread in investment grade is going to attract a number of buyers. And then if interest rates, particularly that market's more sensitive to the 10-year part of the curve. If we were to do 10-year breach 3% again, I think you're going to get a number of all-in yield buyers. So we're not that far away. So I think there is a lot of capital on the sidelines, and we can't ever really forget about that.
Yeah, this morning about 20 basis points away from 3% on that 10-year yield. John, thanks so much for joining us this morning. John McClain, Brandywine Global Portfolio Manager. Coming up, the University of Michigan's Consumer Sentiment Index has plunged to an all-time low during the Biden presidency. But who's to blame? We'll discuss next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today on Bloomberg ETF IQ, a conversation with investor Cathie Wood. That's at 1 p.m. New York time, 6 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Danny Berger in London. Anna Edwards is off today. Well, blame election deniers. Measures that track confidence in the economy are being skewed downward by politically disgruntled Americans. That's the latest topic in a new Bloomberg opinion piece by Bloomberg News Editor-in-Chief Emeritus Matt Winkler, who is joining us now. So, Matt, just talk about this correlation you find between deteriorating consumer sentiment on the one hand and those who don't believe President Biden actually won the 2020 election on the other.
Great to be with you. Well, we already know that 70% of Republicans don't believe that Biden won the 2020 election. And if you take that fact, sadly, into the realm of economics, what you see is in the greatest recovery ever in the shortest amount of time, which is our economic recovery from the pandemic of 2020, consumer sentiment just plummeted and continued to plummet. So it made no adjustment whatsoever for the rebound in the economy. And as you know, unemployment was well north of 10%, and now it's at 3.5%, 53-year low. We know that the poverty rate was cut in half. We know that just about every measure of housing and all the elements of the economy went almost straight up in 2021, and yet consumer sentiment defied all of these things.
Well, as measured by the University of Michigan, right? Because it's actually an anomaly. If you look at other consumer data, you don't see such a dip in sentiment. Right,
and that's why, you know, it's important to make the comparison with the fact that how can so many people still say that the 2020 election was in any way stolen? It just makes no sense. So this sentiment indicator parallels that.
Speaking of making no sense, I noticed a chyron on Fox Friday, verbatim, White House misses forecast with slower July jobs growth. And this is exactly the kind of thing that leads into disappointing sentiment on the Republican side.
Yeah, I mean, look, there's no doubt we have mischievous messaging, and that's what you were talking about. So at the same time that we're getting the facts, so to speak, like the jobs number on Friday, you have all kinds of ostensibly accurate or news reporting outlets saying just the opposite or worse. And so this is, you know, a variable that is clearly affecting the way people think.
Hey, Matt, Danny here in London. So look, if we have this reflected, this bias input into the University of Michigan sentiment survey, what does it mean for us then that we have Chair Jay Powell citing it in his decision and the fact that you have markets trading off of it when it doesn't completely reflect the economic reality on the ground?
Well, the purpose of doing this column is to remind people that context is everything. And so if anyone is going to cite this indicator in any way that is leading to the discussion of where is the economy, they need to provide the context that this indicator has been very misleading and is an aberration. And once they provide that context, then I think it's helpful to put it in the proper perspective.
Just want to talk quickly about really the biggest story of the day, and that's the legislation that was passed in Washington. What do you make of the incredibly slimmed down bill? I mean, we're looking at a $6 trillion suggestion at first, and now it's, you know, less than 500 billion.
So you need, again, here's the context.
Exactly.
It's the biggest commitment to dealing with climate change ever. And if you think that climate change is the existential threat of our time, which I think it is, this bill goes a long way for the first time for American government to deal with it. And this hasn't happened before. So it's unprecedented.
Yeah, well, and don't forget the drug pricing, right? I mean, that's...
There are a lot of other things that are part of this, but that's clearly the biggest one. But there's no question that, you know, if you want to bring down inflation, you have to bring down the things that are driving inflation, and drug costs clearly have been a big part of that.
Absolutely. Matt, great to have you in the studio. Thanks so much for joining us. Matt Winkler, Bloomberg News Editor-in-Chief Emeritus. In related news, 5 states will decide if the 2024 election can be stolen. In the latest Big Take, Bloomberg analyzed every proposed election law in the U.S. since the 2020 presidential race and identified the states most at risk of political interference. You can read all about it on Bloomberg.com or by typing NI Big Take into your terminal. This is Bloomberg.
I don't think the Fed has the thread right now. Now, when we're seeing wage inflation unambiguously after this number, accelerating after this number, after the ECI, after the Atlanta Fed, we have, by every reasonable measure of core inflation, inflation running somewhere plus or minus 5%. That is not acceptable by any dimension.
Former Treasury Secretary Larry Summers speaking on Wall Street Week ahead of consumer price data that's due on Wednesday, set to show a slight retreat in inflation, but of course it doesn't have to come in on survey. Tom Keene, co-anchor of Bloomberg Surveillance, joins us now. And Tom, I was just talking with Matt Winkler about inflation driven in a large part by drug prices. Historically, we're going to see a change in that now that Medicare is going to be able to negotiate prices.
Well, that's the rumor at least, and we'll see how that works out. Much to go, including they've got to get the bill passed through the House and to the president's desk for signature, and that will be the enthusiasms of the week. Let's look back, folks, and Robert Jameson is a jewel. He's with Bloomberg News. And Matt, what's so twisted about Robert Jameson is he's an anthropology major, and you know what they were like in school. So let's go to the twisted Robert Jameson, who looks at Medicare and Medicaid and compares and contrasts it to the GDP might of the nation. It's a deceptive chart. The boom coming out of Lyndon Baines Johnson in 1965, and up we go to a pivot point with Richard Nixon. And this is moving from about 1%, I should say, of GDP, where we are now out to 6% of GDP. And this goes back to all the political emotions of the socialization or the federalization of medicine in America, still a third rail topic.
Given that focus, it's quite perfect, Tom, that you have Libby Cantrell, PIMCO head of public policy, on today.
Well, they got to put it into effect. The answer is, and the first readings I've done are amateur like anybody else. Let's say, Danny, it's 6,000, 7,000 pages. Who knows what it is? But you've got to put it to work, and that's where Libby Cantrell really shines, and we'll talk to her about that. Timely, Peter Scheer will join us. Really looking forward to talking to him about off jobs. Before inflation, what yield will do.
All right, Tom, thanks so much for joining us. Tom Keene there, Bloomberg Surveillance creator and anchor. That's coming up next. Now look at what else we're watching. Kathy Wood on ETF IQ today. That's the program that I co-host with Katie Greifeld. On at 1 p.m. New York time, we are going to interview Kathy Wood for the full length of the program. So definitely one to tune into because, as you know, Danny, the value of the fund has been cut in half over the last year, but flows are still fairly strong. Flows are still positive, even as the value of the underlying stocks, although July was pretty good, for the most part, have taken huge hits, as is illustrated by, for example, Softbank today.
Yeah, I was just looking up the data, $1.6 billion worth of inflows year to date, which you definitely would not expect given that its value has been cut in half over that time period. Well, from the markets to something that I'm just kind of trying to channel my best Anna Edwards here while she's out. I have my eye on the UK Conservative Party contest. There's a report out from the Telegraph over the weekend that Liz Truss may change the BOE's target. Instead of looking at inflation, it would focus on boosting the economy, which of course would be a massive, massive change. It's not something other central banks are doing. And Matt, of course, you know, this comes as we get UK GDP out later this week, and it's expected to show contraction there.
Will be very interesting. I saw a Bloomberg opinion column today that described Liz Truss as Sarah Palin with a British accent. Harsh.
Is brutal. I will put none of my thoughts onto that. All right. Well, that's it for us at Early Edition. More surveillance up ahead. This is Bloomberg.